In my Day Trading for a Living lessons number 24, 25, 26, and 26A, I started talking about hedging and presented it as preferred way of trading, as a way that replaces stops and allows for the management of losing trades in a way that in most cases allows a trader to undo the loss, and in some cases make profit on the originally losing trade. For some mysterious reason, my mind played a trick on me and created in me an embarrassing delusion about hedging. When you hedge a trade, you take an equal in size trade in the opposite direction instead to taking a loss. This maneuver does not nullify the loss which you incurred from your entry point to the point in which instead of a stop loss you hedge the position. My delusion was about thinking that not taking the loss means that there is no loss, while in fact at the point of hedging your account has already incurred a loss. The only difference is that this loss is not realized until the time when you take the hedge off in order to change your trade hopefully into a profit. The market does not forget that at the point of hedging your account has already incurred a loss which will have to be overcome during your hedge trade management. And now look at the image on your screen. It shows how hedging turns into a disaster. The disaster is about the great complexity of trade managing maneuvers as you try to do whatever you can to get out of the hedge and steer your trade into profit. My first entry, a short taken when I thought that from there the price action will bounce down, is marked by the short horizontal black line labeled first enter, as the price action went against me, at the level of losing 0.5% of my account. Marked by the horizontal line labeled first hedge, I placed that hedge instead of taking a loss. From there along the 1 hour bullish bar, the price action was bouncing up and down, forcing me to take consecutive enters when I thought that the price action has finally decided to go down, and also consecutive hedges when I saw that the price kept moving higher. At the top of this huge 1 hour bullish bar, it looked like the market was ready to fall down, so I started piling in many shorts for the purpose of undoing my hedge and shifting into profit as fast as I could. Unfortunately, after the market moved down for a while, it started going up again, and it turned all of my piled into a narrow area shorts into a mega loss, requiring a mega hedge because of my refusal to take a loss and having to keep on hedging the trade. The last fifth hedge has a size of 900,000 units. This size required a huge margin to maintain this hedge, but even this size was not enough as the price action started moving above that hedge, showing the potential for needing even more hedges and more margin on the account. As you can most likely see, I was not a happy camper when I had to activate my fifth hedge. Thank God this trade was taken on a demo account, and as it served to undo my euphoric hedging delusion, it did not make me lose any real money. Here is a breakdown of why using a hedge instead of a stop loss is a bad idea. The core problem: locking in a loss and creating complexity. A stop loss is a straightforward order that automatically closes a losing trade, taking a defined and accepted loss. Hedging, on the other hand, is a risk reduction strategy for existing portfolios, not a tool for avoiding losses on a single bad trade. When you use a hedge instead of a stop loss, it typically looks like this. You take a position that starts moving against you. Instead of accepting the loss and closing the trade, you open an equal and opposite position on the same asset. This does not reduce your risk. It locks in your floating loss on the original trade. The market can move up or down, but your overall equity will remain frozen, minus costs, the high costs and hidden risks. Replacing a stop loss with a hedge introduces several significant disadvantages that compound the initial problem. It's just an expensive pause. Hedging this way doesn't solve the problem of your losing trade. It just pauses it. You are still exposed to the market, and the opportunity to cut your losses and move on is gone. It eats into your capital. Maintaining a hedge isn't free. You will incur additional costs like spreads, commissions, and daily swap rollover fees on the new position. This slowly drains your account while you wait. This is often called the cost of hedging. It creates a false sense of safety. A hedge can provide a dangerous psychological illusion of safety. In reality, your account equity is frozen, and you face decision paralysis, the stress of not knowing which side of the trade to close, often leading to holding both positions indefinitely. A stop loss is simpler and more effective. A stop loss is a disciplined, automatic mechanism for limiting risk on a single trade. It is simple to implement and helps remove emotion from trading, which is a primary cause of losses. When is hedging actually used? It's important to note that hedging is a valid and crucial strategy for professional risk management. It is used to protect an entire portfolio or a long-term position from broader market moves, not to avoid taking a loss on a single trade. For example, a business might hedge its currency exposure to protect against exchange rate fluctuations over months or years, accepting the cost as insurance. However, using it as an emotional reaction to a trade going wrong is a misuse of the strategy and a recipe for disaster. Conclusion: replacing a stop loss with a hedge is a bad idea because it turns a disciplined exit into an expensive, complex, and stressful situation. It locks in a loss without solving the underlying problem, incurs additional costs, and often leads to worse outcomes. For most traders, accepting a small, defined loss with a stop loss is the more professional and effective choice.